You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play.
We've all heard that financial advisors with option knowledge can distinguish themselves from those FAs who don't understand or use options in their practice. In our next panel, Gary Franklin, Vice President and Manager at Options Trading and Strategy at Raymond James, and his panel will explore FA option use and how it grows and enhances their business. Please welcome Gary Franklin in our panel.
Thanks, Bill. Thanks for that intro. Oh, wait a minute. I think somebody, did any of you guys leave your sunglasses up here? See some sunglasses from Options Play? Maybe Tony Zhang from Options Play left them up here after that Millennial Conference panel yesterday. Anyways, I guess I'll keep these.
Those lights, huh?
All right. Settled here. So, before we get started, I'd just like to, thank everybody for coming out today. And one of the things that I've been coming to this conference for many, many years is you guys don't know who the real customers are in a lot of ways. And so today we have actual real clients. So that's something that I feel is very important, that we should get their perspective and see how we can assist them. One of the things I was thinking about is to keep in mind is, we're going to discuss our views, and they might not necessarily be the views of our firms that we represent, but it gives, a good perspective of where we come from. And just before we move on into our discussion, just to kind of give you a background, my name is Gary Franklin, I'm manager of the Retail Options Trading and Strategies Group for Raymond James. This actually marks my 18th options conference in a row. So, just seeing this industry grow from when I started, there was 3 exchanges. You put an order in, and it took 3 to 5 minutes to find out if you had an execution. And to see how far we've come, now there's 15 exchanges, and with a click of a button, you can trade thousands of contracts. So, we've come a long way indeed. And with that, I'd like to have each one of our panelists introduce themselves, and we'll get started.
Thanks, Gary. My name is Paul Feinstein with First Republic Wealth Management. I've been an advisor for about 23 years. Started my career at CIBC, where I kind of fell into the same institutional model a lot of advisors ran, which was basically farming out to SMAs and do the allocation work. At some point in 2007, during the transition to UBS, where I spent 14 years, I kind of abandoned that model just because I felt that model wasn't serving the clients to this best interest. And when you look at past recessions, all these SMAs that we thought could outperform markets in good times and bad times just kind of fell short. And so I started running an index-based strategy late 2007, where it was supposed to be, the core to clients' portfolios. And I looked to the option market to drive cash flow. And, lo and behold, as you all know, in 2008 and 2009, the option premium was just very, robust. And, we were generating anywhere from, 100 to 300 basis points of option premium per month. So, my epiphany or the eureka moment said, hey, listen, if you can replicate the return of the S&P 500, but do it through option premium, you have a pretty successful, program going and still maintain, 90, 92% of the appreciation. So that one strategy kind of morphed into 5 strategies, which was, from an enhanced buy right strategy to, a balanced strategy that kind of used still that same equity, to a short straddle, and to what I do now, which is a put right strategy for big boy accounts. And so my business is, dramatically morphed into an asset management business that, I run 5 or 6 different strategies for clients. And so I've been a huge adopter of the options industry, and I think it's a valuable tool for our clients and just something that we need to continue to enforce.
Thank you, Paul. We have Ed from Morgan Stanley.
All right. Good afternoon. Ed Gesten, Morgan Stanley, and I live in this beautiful valley. I've been in the industry for 40 years with the same firm, predecessor firm. I trained in 1977 with Loeb Rhodes and Company, and fortunately had some terrific education and training throughout that period. So my business today, I'm a sole practitioner. I know that is an exception in this world, but I like it that way. I have an admin that's brilliant, and we run about $500 million. I have strategies that are client-driven, so I probably do a lot less option business than the gentleman on the panel. But fortunately, at a firm like Morgan Stanley, we have a gentleman named Robert Bodner, who has been a great partner of mine, and he's here in the audience. So I have a client that has a specific need, and I would come to Robert, and he would provide me a plethora of data that makes me look better. And that's really the goal, to always represent the client first, second, and third, and try to keep your credibility and your reputation. So I'm happy to be here at this conference. Really, I'm not going to add much to that, but welcome to Scottsdale, Arizona, or Phoenix, I guess.
All right, thank you. And we have Jack from Merrill Lynch as well.
I'm Jack Gunter from Merrill Lynch, LOS 47. Way back when I used to do options, when I read the advertisements in Barron's on the weekend, and you had to do one at a time. I actually had an order on the first day that the CBOE started back in the 70s, and so I've been in options for most of my career. And I'm a very simple person. I buy quality stocks, I write covered calls, and I have a good portion of my business doing it that way, fee-based, discretion, and my clients like it. They have no clue what I'm doing, but they know I'm doing something for them, and they're comfortable with my strategy of just writing covered calls.
Perfect, perfect. Thinking along those lines with clients, what was the catalyst that once you joined the industry, where you said, you know what, I want to explore covered calls or using option strategies in general? Did you start with your own accounts, or did you have a mentor that brought you guys along? How did the story begin?
For me, it was late 2005, 2006, where clients started becoming more and more nervous, and they were asking about hedging out risk, using a collar. At that time, I had a typical client for us would have 20 different sub-accounts, broken down by style box. And it was impossible to hedge out that risk. The only way you could actually do it is kind of run a more simple portfolio using indexes. And so what we started to do is we started to look at this whole change of indexes and had this core satellite model. And then one of the benefits of running that core satellite is you can express your macro views, so small cap, large cap, international, emerging market REITs. You can do that in a very simple one account, and your overweights and underweights will obviously show you success. But the benefit is you can also write options against it. Right. So if you really thought that you wanted to hedge out the risk, you can perfectly hedge out the risk. If you wanted to drive cash flow, you can sell calls. And I guess the eureka moment for us was when you started looking at the option premium on SPY. And during that time, obviously, VIX was elevated and a lot more premiums to be had. You did the math, you're generating 70 basis points of income per month. And that's, you annualize that out, that's a pretty substantial return. So, when we started approaching clients on it, giving up some of the upside and still generating cash flow was a very compelling story. So they all embraced it. And I did it throughout my whole book.
Right. Jack?
Years ago, I bought calls for myself on controlled data. It was a stock that started about 25, and I exercised the calls when it was 120 or something, and I thought I really knew what was going on, so I kept buying calls, and then the tax loss carryovers continued. But then I read an article or several articles that 95% of the call buyers lost money. Well, if 95% lost money by buying calls, then that money had to go to someplace, and that was to the sellers. So that is why I started writing calls. If the buyers were going to lose money, I might as well put their money in my pocket. And it was really that simple.
Right.
But that's a throwback, control data. We're really dating ourselves up here, right? So I would jump in here, use the word math. I don't know these guys, and I just met them, but I would suspect they're pretty good at math. And that's what I like about the options markets. And with the help of the analytical tools that were made available to us and still are available to us, is ultimately we're all in a fee-based business here, and we're compensated based on returns. So we're pretty good with arithmetic.
Right.
And if we can develop a strategy where there's an asymmetric risk and reward, which clearly you can do in the option market, that's interesting to me. And Jack and I were talking. He's 47 years in the business. I'm 40. I think you're a little older than me. I said, "Are you thinking about retiring?" He says, "Never." So what does that say? And I don't want to retire either. And this is a fascinating business with some amazing people. And you mentioned the word earlier about the word client. I said, that really resonates with me because I feel I'm a client of Morgan Stanley, and I need to be treated accordingly. It doesn't always happen, mind you. Again, I'm going to promote Robert. I'm his client, and to have that respect that he knows that I know what I'm talking about, and there's 17,000 of us. It's difficult for him to take these calls. So, we develop relationships with our clients or with our firm or with traders or whatever desk we're on. And I think that's what your clients and why they're still with us for all these decades and decades.
Right. Thinking of your individual firms, talking about Robert and Rich Guerin with your firm. How do you leverage the desks? How do you guys enter your own trades? Do you use the individual desks? Do you leverage the strategy teams to come up with new ideas, bounce ideas off of them? How do you take that approach?
My previous firm, UBS, we had, I thought two of the strongest guys in the industry, Gary Seminara, which might be out there now, and a guy named Al St. Jack, who's, they were mentors to me. So anytime I had question, I would reach out to them and say, hey, this is what we're thinking about doing. And anytime I had to leverage off, like if I was in the money and I wanted to roll the contract, I would always call Gary and just bounce ideas off of him. Right. And it was just a great resource.
I would echo the same. This business is a sophisticated business, and I certainly can't claim to understand the real value proposition and premiums. And I need to understand whether this makes sense. But I think it's easier, for us as advisors, is that we have a clear understanding of what our objectives are. It gets back to goals-based investing. We understand our client, and we understand what the scenarios, the outcomes could be. And once you have a firm grasp of that, the strategy kind of takes care of itself.
Definitely. Jack?
The technology that we have at Merrill Lynch is quite good in the sense that we have one program that keeps track of the options for me, and when they go ex-dividend, and gives me the opportunity to roll my calls before the ex-dividend dates. We have a trading desk that is quite good, that when I have 50 or more options, I can press a few buttons, and everybody that has the one option, I can automatically roll to another one, and they do a very, very good job. For the smaller trades, then I have a team. I make 100% of the option decisions, but then I have a couple other people that can enter orders for me on our normal order entry system.
Right. Earlier, there was, with the research study that came out, I would consider you guys part of the mega team, assets under management level. Do you have people that, you have a tax guy, a estate planning guy, an options monitor type person? How are your teams built?
My team is built as a vertical team, so it's me, and I have 4 support people, all senior professionals, CFAs, going back to, this is your strategy. You have to take ultimate responsibility and ultimate control over what you're doing with it. But everybody can affect trades. Everybody can, there's a lot of redundancy on my team, so there's a lot of overlap. If someone's out of the office on vacation, we won't miss a step. Someone can move into her role or his role, and if we're still trading, we're able to affect the trades. But we also leverage the resources at our firm. And one of the attraction for me at First Republic was basically, they're very pro-business. They're pro, this is your business, we're going to support it. There's a lot of infrastructure that we can leverage off of. And, you bring in more people, they're not officially on your payroll, but they're officially part of your team because they help you operate your business on a day-to-day basis.
Okay.
Yeah, I would chime in, again, as a sole practitioner, we don't have team meetings. Actually, with my admin, I do. So what I've developed, and this isn't new, I have virtual partners all over the country from every facet, incidentally. And you mentioned CFA or CPAs and attorneys. And so bond desks and analysts, I actually have a travel consultant that handles my clients' travel needs. So I try to provide that kind of concierge service. Mm-hmm. And that's just how I've been able to do it by myself.
And Jack, you mentioned, previously that with your clients that they trust you. You've been doing this for over 47 years, but you do, they have to buy into the story about what are the benefits of, generating income from covered calls, or if you're buying protection to hedge your downside risk. They obviously have to buy into that. Do you have like a certain story that you kind of go with, or is it, how does that conversation go with the clients to make sure they're comfortable, even though they don't have to know every detail, but they have to be comfortable with the process?
And it's a good question. Again, I'm a simple person, and my clients do not understand our industry jargon. So I talk to people about rental income, that we are buying a stock. Rather than buying an apartment complex, we're buying a portfolio of stocks, renting those stocks out, getting the income. If you had a duplex or an apartment, you'd hire a manager to do all the work for you, collect the rents and things like that. They're hiring me as the manager of their rental stocks. We're getting the income. There's a contract with each one of these, just like there is in an apartment building. And so they understand rental income. Especially, I'm out here in Mesa and Gilbert, Arizona, and a lot of people are involved in real estate. They understand rental income. If I started to talk to them about covered calls and rolling calls and puts and everything, they would glaze over. They understand rental income. It's a very simple concept for me to talk to people about. And in a retirement account, I don't have to worry about tax consequences because the calls are all short-term gains. But they understand rental income. They understand that that rental income helps hedge their downside risk in a portfolio. So it's very simple. They just don't understand the ins and outs of exactly how I'm doing it. They understand that I'm getting rental income for them.
Right. This I have to give credit to Eric Cott. I think he's in the room from the Option Industry Council. This question is from Eric, not from me. Do you ever turn away clients that don't want to trade options? Do we ever turn away a client because they won't let you include options?
I haven't yet. But that's also part of the whole educational process. When you take on a client, depending on their level of sophistication, they may not understand it. And using the analogy of real estate is a great analogy because most people can get that. But it's, we're an industry and we're supposed to be educating our clients. Again, shout out to Eric Cott just because, he's been a strategic partner for me from day one. He's been a great advocate about education and giving us the tools to help educate clients. And, we're in an industry that, a lot of advisors don't really know how to use options, and they need to be educated. At the end of the day, we have clients, and most of those don't really understand the whole option industry. So I think we're in a position that we can show that benefit just by breaking it down and making things a little bit simpler to understand.
Right, Ed?
Well, I've turned down clients, but not for the reasons that they wouldn't trade options.
Right.
There are other reasons. And, the industry that we all are in today, with the pending changes, with coming up with DOL and eventually FINRA, we're all feeling it as advisors. And we have to be transparent. And you mentioned education. I think that's really key. I love your analogy of rental income, by the way. It always amazes me in how very intelligent people still don't understand what a put or a call is. Come on, it's not that tough, So finding a way to bridge that and put it in jargon that they would understand. So what I tend to use would be, it's insurance. It's a form of insurance that they understand. I don't use the word leverage, and things of that nature. And I think ultimately, we talked earlier, if they trust us, which they have very good reason to, they wouldn't be with us all these years, that's probably enough of a conversation to get them over the hump.
Right. We've talked about dealing with the clients and working with our trading desks and our strategy teams. What is the atmosphere, and has it changed over time from the back office, from your compliance folks,
Whoa.
from your regulators internally, with all the audits that we are constantly going?
You don't want to know that one.
Do we want to touch that topic, or
We'd be here for hours.
I'll touch the
All right,
topic
here we go.
because something happened a couple years ago that if you just do covered calls, we do not have to redo the option form every 3 years. It is supposedly, I say supposedly, good forever. So that was a tweak that was beneficial for people doing just the covered calls. Our compliance people don't understand if you write a call that's 10% in the money, maybe that's, they don't understand that could be a good thing. Right. But it's also educating our management teams, our operations manager, our compliance people, because they don't understand what we do, so we have to educate them to listen to us and to trust us.
I think there's, the back office at UBS, I can speak, a lot because I've been there for a long time, but the back office still didn't really understand, the use of options and covered call strategies. They still mark the opening documents as aggressive. By nature, writing a covered call on a stock is making that position more conservative to some extent. So there's still there's still a stigma against the option industry, even in the back office. Mm-hmm. Mm-hmm.
Yeah, I read recently, I don't know if this is accurate, that at JP Morgan, 1 out of every 7 employees is in compliance or legal. But I can tell you, we would all comment here that the amount of continuing ed that we have to do, there's just so many hoops that we try to run through, and they don't really understand what we do, which is a shame. In other words, they would provide you with something you need to do, but they wouldn't really understand why you needed to do it.
Right.
And in large organizations, particularly, and in all due respect, that has a McKinsey overlay to it, as my firm certainly does, there's a disconnect between what we do advising clients and what they do back there in Gotham City. But we work through it, and this is a great business, so don't get me wrong. I'm not negative. I'm just saying and it's getting tougher. And you didn't mention fees, and I'm sure it's fee compression, fee compression, fee compression. So that's another issue, and options are expensive. So we have to discount, and when we discount, oftentimes we're not even participating in the economics, unless it's in an advisory account. So that's part of the reality as well.
Now, do you have transactional accounts that
Yes,
you do?
I do, absolutely,
Okay.
yes.
But not in options.
Right.
At least for me, not in options.
I do.
Yeah, I don't. Everything's fee-based.
Everything's fee-based?
Yeah.
Okay. And do you think, I know the DOL rule will probably evolve, but my understanding is that the fiduciary side of the rule is going to happen.
Yeah.
Do you think you'll go more fee-based, or,
I'm predominantly 100% fee-based, so
Well, I'm almost fee-based as well.
Right.
So I was honest. I told you I don't do a lot of option business. These are concentrated positions. These might have been insiders, or they retired and they have large amounts of one stock, or they just accumulated a lot of that one position. So in all fairness, especially very low basis, that wouldn't be proper for me to put that in an advisory account because the fee would be too high. But that's the value add. And many of my accounts, they'll have a fee-based account and a brokerage account. I tend to do fixed income outside of the fee-based account as well.
And along those lines, if you guys are moving, and at Raymond James, most of our options transactions occur in fee-based accounts. Do you let positions get called away? Or do you look to roll them because you're in a fee-based relationship, and you don't? If you sell it at a call at $1 and you can buy it back for 10 cents and sell that fatter premium a couple months down the road, if you're in a fee-based account, does that impact how you do things?
I always try to align my interests with my clients, so I want to have the ability to roll the contract, let it get assigned, and not have that affect whether, what structure it is affect whether I do it or not. I do let things get assigned, depends on how things are trading, but that's helped you and hurt you in certain situations. And so, there was a great paper written by Barclays, the European derivative team, and I forgot when they did it, but they did, a global, actually it was a buy right strategy based on SPY, and they went back, the 2000 and 2010 period, and they looked at all these. It was a quant study, and it was done really well. And so I kind of tried to adapt a lot of their output to what I do, and kind of monitor along the way. So there are times that I'll let things get assigned, and other times I'll try to roll the contract.
Okay.
Go ahead. Well, my simple answer, really, since I told you I'm dealing primarily with larger positions with lower basis, the last thing I'd want to do is get taken out of that position. So I watch the X date, and we watch the premiums, and we would roll them. They're used as defensive positions. I'm not interested in getting out of that position.
Okay.
With the fee-based accounts, I can be exercised because I was exercised on about 10 different situations this morning. But I could go with a fee-based account. It doesn't hurt me in a retirement account. I can just go in and buy back the stock if I want, sell another call. It's the equivalent of rolling it, except I'm just doing it with the stock. So the fee-based account allows me to do that, and I had one today that was in a non-retirement account. So I did a versus sale. So the sale will go against today's purchase, or I bought it versus the sale. So I don't have the capital gain situation. So but I can do that in a fee-based account because there are no commissions.
Correct.
One of the other points I'd make is, I also run a put writing strategy. So there are times that I will want to get assigned. There's other times that I would want to roll that contract and look for a better entry point.
Right. Thinking along those, kind of going off the rails a bit, thinking about selling puts, right? What is when you're talking about that with a client, the stock's at 50, maybe you say, hey, we think it's a little high, but let's sell a 45. Collect that dollar, put that in our pocket today. What's the conversation like with the client if, say, the stock goes from 50 to 40? Are they still on board? How's that discussion go? Because you bought it you wanted to, thinking about the compliance folks, right, in your back office, and they'll say, oh, options are more risky than buying the stock. And you're like, wait a minute, the stock's at 50, I sell a 45 put, and I collect $1. So my average price is 44 versus the guy that bought the equity and he paid $50.
Right.
Right? So, their eyes glaze over, but then they know if they write it down slowly, they figure out the math pretty quickly. But in that same example, if the stock falls to 40, you've bought that stock cheaper than you would have bought today. But what's that like with a client? How do you talk them off the
There's the educational conversation you have prior to going into the trade, whereas there are times that you have the ability to roll that contract out first, so you don't necessarily will get assigned.
Correct.
Okay, so you do have the ability to pick a different entry point, and you can also do the math. You can do a positive credit roll if you had to, but at the end of the day, if you do get assigned and it does drop down, you have to remind them of back the conversation you originally had. If they were willing to buy it at 50 and they wanted a discount at 45, getting assigned over a short period you might see a negative return there, but over the long run, you've picked a better entry point. And I think it's, when they see it in action, there was some trades that we put on last year where obviously, we put them on a company that we all love, but, they missed earnings. The market punished them. We got paid handsomely for that option. So our basis was still slightly, we had a positive credit if we got assigned, and the trade worked out great. Right. So, it's part of like showing them examples in real world are very helpful.
Mm-hmm.
So I think, say if you're doing you're selling a put for the obvious reasons that you don't mind owning the stock. I think it's obviously very important that you know the kind of client that's going to understand the strategy and act like a grown-up if something doesn't work their way. I can recall in 1987, before the stock market crashed, the idea of selling out of the money puts was a great way to generate income. Premiums were really high. And this is the days when the Philip Morrises of the world and the Lillys, and they were running, and these stocks went up all the time, and people were quite euphoric, and it looked easy. Well, anytime anything looks easy, it's not. Mm-hmm. So I just think it's basically protecting our franchise and our sanity to pick the right clients for strategies that can be as sophisticated, as volatile as that.
I agree.
Yeah, and along those lines, like for me, I think my first options trade was in, I want to say either 92 or 93. I was working in the back office and decided, I picked up my Series 7 on my own, decided, options sound interesting. So I went and I got approval to take my Series 4 to be an options principal. And I'm just working in the back office, right? So I passed the test and I started trading my own account and everything. So I've been doing this for a long, long, long time, even before I was even on part of the options team and everything. But through my travels of branch visits and going out and seeing you guys in the field, I found that a lot of people, even though they might not be using options, they have in the past. And you hear a lot of stories about in the 80s and even through, the .com days and stuff. Do your peers, do you think that is accurate, that they might not be using options, but that they have experienced it in the past, and also translating that to clients? What's your views, Jack?
Most of the people in my office are not familiar with options at all. The financial advisors, there's a handful, but most of them are not fluent in the option terminology, and they don't understand how they can benefit clients. So there's a desperate need, I think, in the education of the financial advisors, because the younger ones are also taught, find a client, take the money, give it to somebody else, let them manage it, you manage the relationship, which is fine, except a lot of us enjoy the individual stocks. And the clients enjoy individual stocks. And they want to know who's making those decisions on what they're buying and selling. And so I'm sort of babbling on, but the clients or the financial advisors in our office just don't understand options, so they stay away from them.
I would concur with Jack, what you just said, but I would expand upon that. There seems to be a lack of curiosity, intellectual curiosity, and it's not just specifically to this strategy. It's amazing to me when I go to meetings, which I rarely go to, the kinds of questions that people ask about things. But in all due respect, there was a question over there about how a person can start in our industry. It's very difficult. The kill rate is extraordinarily high to be successful, maybe 10%. Maybe that's a stretch, Jack, but and they have a lot of pressure. They're under a time clock, and they're under management control, and they have to do what you just said. They're not sophisticated. They don't have the time to learn it. It only happens later in your career, and there's so much competition. And when you got Vanguard selling S&P 500 for 4 basis points and a passive strategy, this resonates. Obviously, we had $1 trillion of ETF flows, and I think since the election, or close to that. And I'm not sure it went to you or me, by the way. I'd like to say it did, but I don't think so. So that's a challenge, big time. Education, it's a big deal.
And is it that our firms are, whether you're at a wirehouse or regional or whatever, so if you're at a wirehouse, maybe the firm is so huge that they can't spread that message to these, half of a firm, say that those advisors, let's kind of segment the groups of the advisors within your firm. It's, from my point of view, there's probably half of the firm that has never used options and probably never will, right? And then there's the other end of the spectrum. There's probably 25% of your firm that are quote unquote active users of options. And I'm not talking about 100 trades a day, but running a portfolio, actively looking and everything like that. But then there's this group that it seems to be in the middle of, around 30% of a firm of advisors that are interested in options, and it came out in the study. But they're curious, they see it on TV, yet how do we get them over the hump? Is it folks like the Option Industry Council that should be coming out to the firms and really spreading the word? What do you guys think? How do we get those guys in the middle that are interested but haven't started? What's your thoughts, Paul?
Great question. It's tough because at the big broker-dealers, they're constantly managing to the least common denominator. And so I think they're very reluctant to kind of push this magic box out to the system. And so for me, at UBS and being a senior portfolio manager and being one of the, large users in that space, it was a constant, I had to push with compliance, I had to push with our local managers just to do simple buy right strategies, and I don't really know the solution because it almost seems it has to be done locally, but you also need, home-based resources because they have a lot of the intellectual, power back there. So it's probably a combination.
Okay, Ed?
Yeah, I would think that the organizations here should really go into these communities and start educating people about this. And I've never seen it done in 40 years. I don't know. It's never happened. You have to appreciate what we see on a daily basis is this chaotic pushing of information at us.
Right.
And if you're young, you really don't know what to do. And probably the least thing they're going to approach is, well, I'm going to start out and use leverage by selling naked puts or something. And it's not going to happen. Or the firm wouldn't even let them do it.
Right.
So the firms aren't as educated. The FAs aren't as educated. And the industry isn't really reaching out. And I would imagine most of this volume is institutional anyway, right? I would imagine, right? So
big portion of the tickets.
There's your answer. If you invited us up here, retail,
right?
Albeit high net worth retail, but still retail. Maybe we all have something to learn to engage us. Yeah.
I mean, I can tell you, because I actually brought it into my portfolios and I adopted it as part of my strategy. And obviously I needed to build presentation materials. It literally took me 2 years to get that through our compliance.
Wow.
And so, there's a lot of educational, I think efforts that need to be made, home office, local, and industry. The industry has to be much more, I think, proactive in it.
Mm-hmm. Do you guys think there's enough products available either through your firm or what you can buy off the shelf for managing and scaling your business that includes options, or have you had to build a lot of it yourself?
I've personally had to build most of the stuff myself.
Okay.
And so, I'm unaware of any of it. Yeah. And I think you said your firm, you're doing it for your FAs.
Yes.
And I'm not even sure it's on our platform. Right. And I would think I would know that.
Okay.
I'd like to go back to your prior question and talking about the education. This morning I got an email that American Funds is in our office to talk about American Funds. Last week, iShares would be in the office. Another time, PowerShares would be in the office. I've never seen somebody from the Options Council come into our office or into our city to talk about options and give that education to the advisors. I mean, really, for me, the education part is the key, and everyone else comes through our office to pitch whatever they're pitching, but never options.
Right. I think it's funny. I've done a little bit of branch visits, which, you know, if I'm going into an area, say I'm going to go into Atlanta, for example, and I'll try to hit 10 branches in a day or something like that. And I've traveled with Bill Ryan and Eric Cott, and we do our best. But it's funny, when we come in, the first thing we have to say is, we're not trying to sell you anything. We're trying to help you. You know, because they get bombarded with all the different mutual funds and ETFs that come through, and they definitely have value in what they're doing. But it's like, hey, we're here to help you. We're here to take that next generation of advisors that just needs to be pushed a little bit to understand what's going on. Because, you know, the last thing I think you guys want to do is try to go, let's do this option strategy, and try to explain it to a client in a simple way. And a lot of these advisors, if they don't have the story down themselves, they never want to admit that they don't know something. So then they kind of shut it off. So I think more grassroots outreach, I think, would take us a long way.
I think there's some context that has to be put in place too, because whenever there is material that someone's talking about options, calls, puts, selling, buying, it's really in a vacuum. They talk about a single position, and that's it. And I think a lot of advisors kind of glass over to it and say, oh, that's great for one position. But I don't think anybody's really kind of looked at it from a broad portfolio. I mean, for me, I run, a strategy that's globally diversified. It's macro based. It's an asset allocation, and writing calls on top of it on each individual positions. You know, no one's actually done the math to really kind of help some of these advisors see the value of those nickels and dimes and how they add up. And you compound that forward. You know, when you really look at returns, it's really about cash flow, and it's reinvestment of those cash flows. And I don't think, the materials haven't been written. No one's really kind of, maybe they are, I haven't seen it, but they need to throw it into some type of context.
And I know there's only one Eric Cott, there's only one Bill Ryan, and on and on and on, Russell Rose. But we're starting to see options on TV and online as well. But, what are your thoughts of, CNBC? There's actual time slots. Has it been helpful? Does it help you sell the story? Does it cause distraction? Thoughts on becoming more prime time with our industry?
I personally love it because I think it just creates more opportunity to have an engaging conversation with the client. The expert traders are out there pitching, positions that they've done or they would do, and I think it's an opening conversation, and I think it does give some acceptance about strategies that we've been employing for many years, but now it's just coming to light, how effective they really are.
Right.
Pardon, in all due respect, I'm from the opposite side of that.
I love it.
Absolutely.
This entertainment on television, I don't think it's really healthy for clients. With a strategy suggestion one day, and they're not accountable for that. We are. Mm-hmm. I have a beautiful flat screen television in my new office. I don't think I put it on yet, unless there's some event in the world that I really want to focus on. So I think they're a joke, quite frankly. I think these talking heads on these financial programs, they're there for one reason and one reason only, to get the eyeballs to sell ads, and that's not education. I'm sorry.
Right,
Oh,
so
yeah,
we got a
no
point.
apologies. I'm
All
saying in the context, it just creates awareness. Now you kind of let the cat out of the bag. You hear about selling puts. You would never have had that opportunity.
I understand that.
So whether they add value because it is, educational, whether it's entertainment, I agree. There's that entertainment component, but just opening the conversation, you need a door opener, and I think they do a good job at that.
Sir,
My personal opinion.
I get it.
Jack, do you want to sway the vote one way?
I have yet to have a client ask me about anything they saw on CNBC about options. Okay. But those guys, they are entertainers, but they're also traders. And I'm not a trader, and my clients are not traders. So they are going to a different type of audience than the clients that I deal with. So I think that because they talk trading and they talk about Congo spreads or whatever they do, is totally different than the strategy of just buying good quality stocks, taking the dividends, taking the option premiums, covered calls. So I've never had a client ask me anything about anything they saw on CNBC.
Okay, all right, and kind of switching gears again, thinking about the exchanges. There's, like when I said before, when I started there was 3 exchanges, now there's 15, and who knows, by next year there might be 18 or 20. Does that matter to you guys? Whether there's 5 exchanges or 20 exchanges, does that impact how you guys trade at all?
I would probably answer is, to some extent, yeah, I think it does influence, the business a little bit, and I think there is some benefit that we reap out of it. It's kind of hard to quantify for me, and I haven't really, seen the difference.
Right.
I'm just generally saying the more bandwidth, the better.
Okay.
But in my case, I'm relying upon my firm in a not-held order to take that trade to the right place and represent my client the way I would hope. So I would think more is better, generally. Yeah.
If the more is better, if they would narrow the spreads, would be very beneficial.
You guys hear that out there?
I'm sorry, the spreads sometimes are quite wide, and the spreads are wider today than they were 10 years ago.
Right.
10 years ago, we only had a few exchanges. We have more exchanges, more computers. Spreads are a lot wider today.
Right.
So I would like to see those spreads between the bid and ask narrow.
Okay, and we're almost out of time, but along those same lines, are you guys using market orders, limit orders? Sounds like I heard market not held, so you're using your trading desk to go out and get the best price for you? How's that?
Right.
Yeah, I use a lot of market not held. I mean, I'm trading everything in block trades. I'd work through the block desk and, compile, it could be 5, 10, 15,000 contracts on a certain position, and I would let them trade it. If I'm doing a roll, then I'm looking for them to look at both sides of the trade.
Okay. Jack?
I'll use limit orders sometimes, and if I don't do the block trade, I'll use limit orders most of the time because of those spreads, and because I'm not trusting of some of the orders that go in market.
Sounds good. Okay, and with that, I found this very interesting to pick your brains and kind of see where we are, and it sounds like the future is bright. Hopefully, this next generation of millennials will take what you guys have learned to heart and take us to the next level. And with that, I'd love to thank you guys and thank everyone here for listening in.
Ladies and gentlemen, Bill Ryan.
That again. Thank you, guys. Okay, please join us at 1 o'clock at the Jackrabbit Pool for what promises to be a fun afternoon in the sun. You can grab some lunch there, have a cold beverage, or take a dip in the pool. Then we meet again tonight at 5 p.m. We meet at 5:30 outside by the flagpoles where, I get this all messed up. 5:30 in the cocktail hour. 5:30 cocktail hour in the attendee hall. 6:30 buses go to Old Town Scottsdale for Bottled Blonde, and the return trip starts at 9 from 9 till 10:30 back here. Be sure to wear your badge tonight for Bottled Blonde, and we meet again tomorrow morning at 7 o'clock for breakfast. Everybody have a good night.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.